Hey everyone, welcome to today's Explainer. I am absolutely thrilled you're here because today we are tackling a massive topic in the world of automated trading. We're going to completely demystify the structural risks of hyperliquid vaults versus copy trading. We see these terms thrown around constantly, right? But understanding what actually happens to your money under the hood when you use them, well, that is exactly what separates the professionals from the gamblers.
So, be honest with yourself for a second. When you see a strategy boasting a flashy 50% gain, are you jumping in without really understanding the underlying mechanics of how that yield was generated? Look, it is so incredibly tempting to chase those numbers, I get it. But if you don't understand the structural vehicle you're riding in, whether it's a vault or a copy trade, you are basically driving a high-speed sports car totally blindfolded.
Okay, let's dive into this. Here is our roadmap for today. Number 1, pooling versus mirroring trades. Number 2, how losses transmit. 3, hidden risks. 4, common mistakes. And finally, number 5, sizing your allocation.
All right, starting with section 1, pooling versus mirroring trades. Think of a hyperliquid vault as a giant bucket. Depositors throw their capital into this one shared, pooled on-chain entity, and a vault leader trades that bucket directly. You don't own individual trades, you just own a proportional share of the entire pool. Because of that setup, you literally have zero individual control. You can't resize a position or set a personal stop loss. Your only choices are really just deposit and withdraw. Now, copy trading operates completely differently. Here, the platform acts like a mirror. The leader makes a trade, and that exact trade is duplicated or mirrored into your own separate, distinct account. Because your account remains completely isolated, you retain individual control. You can set a maximum position size or cap your total allocation, all without affecting the leader or anyone else in the slightest. Moving right along to section 2, how losses actually transmit. Okay, so picture this. You've allocated your capital, everything is going fantastic, and then, bam, the leader takes a bad trade. A really bad trade, an unavoidable 15% loss on the capital they are managing. Look, this happens, but the real question is, how does that 15% actually hit your wallet? Now, what's really interesting about this slide is how the exact same 15% leader loss transmits totally differently based on your structure. In a vault, that loss applies proportionally, simultaneously, and immediately. If you have a $2,000 vault deposit, you instantly take a $300 loss. There is absolutely no way to override it. But what if you copy traded that exact same leader, but you used your individual control to set a strict $500 personal exposure cap on that specific trader? Well, that 15% loss is constrained by your settings. You only lose $75. The underlying loss from the leader was exactly the same, but the structure and the individual control it preserved dictated a vastly different financial impact for you. Let's look at section 3, hidden risks behind headline returns. A headline return literally tells you nothing about the survival risk taken to get there. Let's say a vault is up 50% year to date. Sounds incredible, right? But what if it had a maximum drawdown of 40% along the way? Could your stomach, or your portfolio for that matter, have actually survived that 40% plunge? Then there's leverage. A 50% gain achieved using 3x leverage is one thing, but 20x? In the crypto world, we kind of call that degen gambling. At 20x, a mere 5% move against the trader liquidates the position entirely. That is a massive red flag. You also have to consider position concentration. Did they make their 50% on one lucky giant bet, or through steady, compounded trades? And finally, capacity limits. A strategy that brilliantly doubled a small $10,000 pool might completely fall apart when millions of dollars are suddenly allocated to it and market impact becomes a real factor. Which brings us to section 4, common mistakes traders make. I see these mistakes happen constantly. First, as we just touched on, judging by total return alone without checking the drawdown or leverage is a complete recipe for disaster. Second, ignoring vault lockup periods. Remember, you cede control in a vault. Many vaults have specific withdrawal delays. If the market is crashing, you might be stuck waiting days to get your money out, whereas copy trading doesn't typically impose those kinds of delays. Third, copying at full proportional size. Just because you have $10,000 in your account doesn't mean you should let the copy trade mirror use all of it. Set those personal allocation caps. And lastly, assuming past drawdown is the worst-case scenario. Markets evolve, and a leader might suddenly change their position sizing or leverage. History for sure does not guarantee the future. I want to completely bust a myth right now. Copy trading is not inherently safer than a vault. Yes, copy trading preserves individual control, but, and this is a massive but, if you don't actually use that control, If you just mirror a leader at full size without setting any personal caps, your risk is exactly as high as a vault depositor's. The safety doesn't come from the structure itself. It comes from you actively utilizing the tools that structure provides. Finally, Section 5, sizing your own allocation.
The reality is, neither outcome is automatically better. They just serve entirely different trader profiles and risk appetites. The vault trader values simplicity above all else. You want to make one deposit, one withdrawal, and absolutely not babysit settings. You are perfectly comfortable ceding all position-level control to the vault beater. The copy trader, on the other hand, wants the leader's strategy, but demands control over their own destiny. You are willing to actively manage your sizing limits and stop controls to ensure a bad leader trade doesn't blow up your personal account. So, which one sounds more like you? Quick safety check here before you decide. If you are leaning towards a vault, you absolutely must read the documentation. Never just assume that your losses are strictly bounded by your deposit. While that is generally true, the specific margin mechanics, leverage allowances, and loss-sharing rules can vary wildly from vault to vault. Always confirm exactly what happens to your deposited capital under worst-case margin scenarios. Also, a quick note on tooling, because this comes up frequently in the source material. Tools like DRKN are absolutely fantastic for reviewing your risk exposure after the fact on connected accounts like Toobit. However, it's vital to understand they are strictly analytical. They do not operate the vaults or the copy trading infrastructure itself. The actual execution and the structural risk lies squarely with the platform and the strategy leader you choose. I absolutely love this quote from our source material. Let me read it to you. The real comparison is not vault versus copy trading in the abstract, but how much individual control over sizing you specifically want to retain once a leader's trade goes wrong. That is the entire philosophy wrapped up perfectly. A leader's trade will eventually go wrong. It's inevitable. The question isn't whether it will happen, but how you have positioned yourself to survive it. Risk management is and always will be your personal responsibility. I want to leave you with this final, provocative piece of homework. Look at the strategy you are currently invested in, or maybe the one you're thinking about joining. Ask yourself, if their worst historical drawdown repeats exactly today, right now, what happens to your entire account balance? If you don't know the answer, or if the answer makes you sick to your stomach, you are sized too large or you're using the wrong structure for your risk tolerance. Thank you so much for joining me on this explainer today. Take control of your risk, do your research, and keep learning. See you next time.